Mix 1041 and MixTV.tv. Right now, we are joined by our friends Jay and Brittany Hagee with Allon Planning Partners. How are you all today?
Doing wonderful. How are you doing?
Good morning.
Good. Great to see both of you. So, first off, I know we've talked a bit about this before, but remind us all how tax planning fits into the bigger picture of financial planning and why it's important to consider taxes in your overall financial picture.
Tax planning is a huge part of your financial picture, right? Most folks, if they have an investment portfolio or an investment, they may look at that and say, oh, okay, I know how I'm positioned, if it's going up or if it's going down, and should I be positioned this way? And we talk about, being in an account that 10 is better than 8. But there's a lot as far as percentage gain is concerned, but there's a lot more that goes into it than just how you're allocated in your investment portfolio. You have an investment management, which is really important. You have income planning, which how do I properly take income from these buckets once I'm in retirement? Tax planning, which looks like, how diversified am I in tax statuses? Are all of my positions in tax deferred accounts? Do I have Roth accounts set up? Do I have non-qualified accounts and brokerage accounts set up? How are those all working together, right, to create a better tax situation for me? Then you have estate planning and healthcare planning. To really get a comprehensive picture, we have to touch on all 5 of those areas. And so right now we're specifically talking about tax planning because we're in tax time. This is what people are talking about. So you want to make sure that you save as much money on taxes as possible. Now, I don't mind to pay taxes because that means we've made money, right? But we also don't want to give Uncle Sam more than his fair share. We don't want to overpay taxes. So you need to work with a good tax professional, and we have a CPA in our office, but you can work with whoever you would like, your tax preparer, your CPA, along with us as your investment managers to make sure that you are in a tax efficient place in your portfolio. Because every dollar that we can save you on taxes is a dollar that I do not have to risk in order to get you to your ultimate financial goals. So you really have to know not only how your portfolio is performing right now, but how it's set up in a tax efficient manner. If you aren't having those conversations with your advisor right now, you're missing a large portion of what we do. So you need to have those conversations.
And a lot of this type of talk can feel like Greek to a lot of people. Like, I just don't understand tax code. And man, it's just so complicated. It's such a drudgery. I don't want to talk about taxes.
Tax code's not easy.
I hate tax time. A lot of people feel that way. And we get it. Like, we get it. That's why we work with CPAs who do know those tax codes so that we are helping our clients work in a really tax efficient manner when it comes to their situation. So we want to simplify all of that. It doesn't have to be complicated. It doesn't have to be overwhelming or daunting. We can simplify the strategies and, hey, let's talk through ABC 1, 2, 3. Like, let's really simplify this so that we can get you working in a tax efficient manner.
We're talking with Jay and Brittany Hagee with Allon Planning Partners. And I'm one of those people that you mentioned. I don't know a lot about taxes, but I do know that there are important ages to keep in mind when it comes to taxes and financial planning. So what should we be aware of? Let's say maybe age 50.
Yeah, age 50 is kind of an important age because at age 50, you can begin contributing more to retirement accounts than you could under 50. So it's what's called a catch-up contribution. So those who are 50 and older can add an additional $1,000 to their IRA, Roth IRA contributions, things like that. So there is an additional limit. And then their 401ks,
they have even more.
Exactly.
Yeah.
So for 2023, the total contribution limit for those over 50 is $30,000 into a 401k. So that is a huge chunk of money that you can contribute into a 401k. Again, that's for 2023. It's different for 22, but I know we're, filing for 2022 now, but looking ahead as we're in 2023, those contribution limits increase at 50 for those catch-up contributions.
Important to know.
Okay, so what about maybe age 59 and a half?
Well, 59 and a half is real important, right? Because you can now take penalty-free withdrawals from those accounts, or you can do a lot of times in-service rollovers of your 401ks to offer broader investment options for yourself in IRA accounts. So at 59 and a half, you have the ability to not only have what's in that 401k account and only have the investment options there, but you can actually roll over your 401ks a lot of times or take penalty-free withdrawals from those 401ks once you hit 59 and a half. Because up until that point, if you take a withdrawal from your 401k, your IRAs, not only do you pay taxes on those, you're paying a penalty of 10% to do that.
10% penalty.
So that's where that penalty goes away. And so it's important to know if you need to start, maybe folks want to retire early, want to retire at 55 or 60. You cannot withdraw from those funds before 59 and a half without a penalty. You need to know that age.
Which here's a little plug for an emergency fund. That is the penalty, that 10% penalty there is exactly why we tell people don't withdraw from those accounts early, because you will not just pay taxes, but you'll pay that penalty on top of that. So have an emergency fund, have dollars set aside for those unexpected expenses so you're not withdrawing from these accounts and paying penalties and taxes on taxes and incurring more expense than you need to.
Okay. So let's talk about the age range between 62 and 70.
That's a big one. If you want to.
Yeah, this is the big issue here is with Social Security. 62 is the age at which you can file for Social Security. Now, a lot of people say, I'm 62, should I file? And a lot of times the answer may be, well, it
depends.
It depends. Yeah, it depends on your situation.
Are you still making income? That's a big deal.
If you're still working, you will be penalized for what you make. There's a lot of caveats there. So it's not a cut and dry, simple yes or no answer. But the bottom line is at 62, you can file for Social Security and begin receiving those benefits. Now, if you do file at 62, you will receive 25% less than your full retirement age benefit. So if you file early at 62 before your full retirement age, you will receive less of your full benefit. That's important to know. If you wait until full retirement age, which for most people is 66 or 67, then you will receive 100% of that full retirement age benefit. And here's something that most people don't realize is that every year they wait from full retirement age, which is either 66 or 67, depending on when you were born, every year you wait to receive those Social Security benefits, that benefit will increase by 8% a year. So that's like an 8% return on an investment. So if you can wait to file and to receive those funds, it really could make a difference in what you're able to receive every year moving forward.
So one of the largest parts of what we do in income planning is associated with Social Security. So between 62 and 70, you want to make sure that not only you know how much you're going to receive when you file, but how do you maximize what you can receive when you file. And so pairing that with your investments and knowing when to draw from these funds versus when to draw from Social Security is going to save you a lot of money and gain you a lot of money over your lifetime.
And
so Social Security,
make sure you're not paying more in taxes, because you do pay taxes on Social Security income.
And that's another story altogether.
But we're talking about taxes today, so I think it's important to just bring that up. You can either pay 0% tax, 50% tax, or 85% can be taxable. So unfortunately, we are having to pay taxes on our tax dollars. Now, I'm just the messenger here, but that's not the greatest news. But that's why this is so important, because there is strategy involved. You don't want to file and then end up just repaying that or paying a penalty or paying additional tax dollars because of that.
That's right.
That's
right. So maximization of Social Security ultimately is super important, because recent statistics show that 36% of someone's income through retirement is based on their Social Security dollars.
It's a huge jump.
If you're not maximizing that and you're paying too much of that in taxes, that's a problem, because that's 36% of your fixed income in retirement. That's why folks want to talk to us. That's why folks want to come in and make sure, Jay, Brittany, when should I file for Social Security and how does it fit with my overall financial plan? That's why we ask people to call in, and we would love to sit with you and discuss that.
Right. And a couple more ages I want to ask you about here. Okay. What about age 65?
65 is the Medicare age. That's when you've got to file for Medicare, and you've got choices in doing that. We work with Medicare professionals who specialize in that, who know all about Part A, all of the different options there to help equip you to be able to know what's best for your scenario. So that's an important age to remember. And your healthcare planning is one of the 5 components of the financial planning piece that we talk about. And Medicare is a part of that, because that's mandatory filing at 65.
Okay. So we're bringing out different ages, things to keep in mind when it comes to taxes and financial planning. So what about age 70?
So age 70 is when you have to take Social Security, right? So, and I'm going to kind of link these last two here, because age 70, 70 and a half used to be your required minimum distribution age. So a lot of folks still think that that's the case, but the last couple of years, that's been moved up. As of this year, it's 73. And so at age 70, you have to file for Social Security if you haven't so far, right? That's the maximization. That's the most you can receive from Social Security. But also, expanding that out, it's not 70 and a half when you have to start drawing those requirement minimum distributions anymore. It's now 73. So at 73, you have to start taking from those IRA and those 401k buckets. You have to start receiving that. So we have to plan for you before you hit that magic number of 73 to make sure you're not stuck in a place to where the government's telling you exactly how much you have to take out and how much you're going to be taxed on.
This matters because of taxes. We want to prevent what we call the ticking tax time bomb.
That's right.
You don't want to get to this age of where you have to take these required minimum distributions and then either be in a place where you don't need them and you have to take them and it causes a massive tax issue, or, there could be a number of things that negatively impact you if you haven't planned for that. So it matters for your taxes as well when you're strategizing and planning, not just. And that's a big part of the financial planning piece. When we're talking about tax planning, it's not just planning for this current year.
That's right.
We're looking, Jay and I, when we're planning with our clients, we're looking at long term. We're looking at, yes, how does this impact this year's taxes for this
5,
client?
10, 15, 20
but what
years
about
from now?
15, 20 years down the road, 5 years down the road when they retire, whatever it may be? How is this going to impact their tax situation?
So ultimately, you've asked from age ranges 50 to 73, right? If someone's listening, they're in those ranges right there from age 50 to 73. There's a lot more planning that goes into your plan right now than it was maybe when you were 35.
30 or 40.
When you were 40, right? You still want to plan at those ages, but between 50 and 73, you actually have to do
you have to
more
make
planning.
some real decisions. You have to file Social Security. You have to file for Medicare. You have to plan for these RMDs.
Yep.
Yeah.
So we would encourage those folks, call in, meet with us, right? You can reach us at 423-315-1441, and we would love to sit down and offer you a no cost, no obligation consultation to see how our planning strategies could help you succeed in your financial future.
Yeah, and these conversations are always no obligation. We always talk about how we're trying to get something to those people we work with. We're not trying to get something from you. We're not trying to sell you a product, or you come in and we already have this idea. Oh, we're going to offer them this. We're going to tell them they need this.
Right.
That's not how it works in our office.
That's right.
It's based on each individual and their situation. What is your need? What is it you're trying to work towards? What are your financial goals? And taking a look at that broad picture, so then we can put together a plan that really fits your specific situation. You can also check us out through the website, allonplanning.com. That's ALLON, planning.com. You can schedule a consultation directly from our website there. You can link right to our calendar, schedule a time that works at your convenience, and come in and meet and talk through your specific situation.
Okay, that's Jay and Brittany Hagee with Allon Planning Partners. Again, 423-315-1441 and allonplanning.com. Thank you both for coming in today.
Thank you for having us, Bridget.
Thanks,
It was
Bridget.
great.
Investment advisory services are offered through Foundations Investment Advisors, LLC, Foundations, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Each individual investor's situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a